So let's continue now with the valuation model. The free cash flow to firm model is used then to calculate the enterprise value. So it's a gross valuation method. That means you have to calculate first the enterprise value. Then we have to add to the enterprise value the market value of the non-operating assets and deduct then from that the market value of the interest-bearing debt to get then the intrinsic equity value, which is then divided by the number of common shares outstanding to get then the intrinsic share value. Here in this class, we just discussed the one-stage free cash flow to firm model. So that's a model that assumes then a perpetual growth then of the free cash flows to firm. So with the one-stage free cash flow to firm model, we have to take the free cash flows to firm just for the period ended, and we multiply that by 1 plus the growth rate of the free cash flows to firm, and that's divided then by the weighted average cost of capital. So that's the expected return of the capital holders, including debt and equity holders, minus the growth rate of the free cash flows to firm. Alternatively, we can just take the free cash flows to firm in the next period and divide that then by the weighted average cost of capital minus the growth rate. And now let's take a closer look at the valuation parameters. So the weighted average cost of capital is the sum of the weighted cost components. So we begin with the market value weight of the interest-bearing debt. So we take here the market value and not the book value, because the weighted average cost of capital is used then to discount back expected future free cash flows to firm, and therefore it's a forward-looking figure, so that we take the market value and not the book value to calculate then the weight of the interest-bearing debt. That's then multiplied with the cost of debt. The cost of debt is the expected return of the debt holders multiplied by 1 minus the marginal income tax rate, and we add to it then the market value weight of the equity times the cost of equity. The cost of equity, that's then the expected return of the shareholders. Now, to calculate the expected return of the shareholders, we can use the capital asset pricing model, and here we have to use then a beta, which is approximately 1. So we can take here a value range between 0.8 and 1.2 then for the beta, because the one-stage free cash flow to firm model is used for a mature company, and a mature company has approximately the same risk as the market. Then if you assume that depreciation and amortization, as well as the change in non-cash working capital, are the only non-cash expenses and non-cash revenues, then we can calculate the free cash flow to firm with the following equation. So we take the operating income, that's the earnings before interest and taxes, multiplied by 1 minus the income tax rate, multiplied then by the difference of 1 minus the reinvestment rate of total capital. So to demonstrate that we can use this equation to calculate the free cash flow to firm, let's write the reinvestment rate of total capital. So the reinvestment rate of total capital, that's the capital expenditures. So we can take the capital expenditures. Then we can deduct from that the depreciation and amortization, and we can add then the increase in non-cash working capital. That's divided then by the EBIT multiplied by 1 minus the tax rate. Now if we replace the reinvestment rate of total capital with this equation, then we can just rewrite the equation above to determine the free cash flows to firm. That's then the EBIT. So we take the EBIT operating income and we multiply that with 1 minus the tax rate. and that's then multiplied by 1 minus the reinvestment rate of total capital. So that's therefore the capital expenditures minus depreciation plus the investments in non-cash working capital divided then by the EBIT times 1 minus the income tax rate. And now we can multiply out this equation. So to calculate the free cash flow to firm, we can take now the EBIT times 1 minus the income tax rate times 1. That's then the EBIT times 1 minus the income tax rate. And then we have minus, then we take the EBIT times 1 minus the income tax rate multiplied then with the reinvestment rate of total capital. So that's then the EBIT multiplied by 1 minus the income tax rate multiplied then by the investment rate. So that's then the CapEx, capital expenditures, minus depreciation and amortization, plus the investments in non-cash working capital, divided then by the operating income times 1 minus the income tax rate. And now here we can just cancel out the EBIT times 1 minus the tax rate, and then we can just rewrite the free cash flow to firm as follows. So that's then the operating income multiplied by 1 minus the tax rate. And then we have minus capital expenditures. Then we have minus is plus, so plus depreciation. And we have then minus times plus, so that's minus the investments in non-cash working capital. If you assume that the only non-cash expenses and non-cash revenues consists of depreciation and amortization, as well as the change in non-cash working capital, then we can calculate the free cash flow to firm using this equation. That means we take the operating income times 1 minus the income tax rate multiplied then by 1 minus the reinvestment rate of total capital.